Name: Devi fejer anggraeni NPM 234111165 Class, Management 23C. I will discuss the report material on financial analysis. Financial statement analysis: understanding a company's financial health. Financial statements are important documents that provide an overview of a company's financial condition. However, simply looking at the numbers in the financial statements is not enough. To understand the company's financial health in depth, financial statement analysis is needed. Financial statement analysis is the process of identifying, assessing, processing, and comparing information contained in financial statements. 1. The goal is to gain a more comprehensive understanding of a company's performance, financial position, and cash flow. Types of financial statements. Before discussing the analysis, it is important to understand the types of financial statements that are commonly used. Balance sheet shows a company's assets, liabilities, and equity at a certain point in time. Income statement shows a company's revenue, expenses, and profit or loss during a certain period. Cash flow statement shows a company's cash inflows and outflows during a certain period. Statement of changes in equity shows changes in a company's equity during a certain period. Financial statement analysis methods. There are several methods that can be used to analyze financial statements, including 1. Horizontal analysis. This method involves comparing financial statement items in different periods. 1. For example, comparing this year's sales with last year's sales. This analysis helps in seeing trends and changes that occur in the company's performance. 2. Vertical analysis. This method involves comparing financial statement items with other items in the same report. 2. For example, comparing cost of sales with total sales to see the percentage of cost of sales to revenue. This analysis helps in understanding the company's financial structure and its operational efficiency. 3. Ratio analysis. This method involves calculating financial ratios that can be used to compare the company's performance with other companies in the same industry or with industry standards. These ratios can provide information about the company's liquidity, solvency, profitability, and efficiency. Benefits of financial statement analysis. Financial statement analysis has many benefits, both for companies and stakeholders, such as: for companies, identifying the company's strengths and weaknesses, making more appropriate strategic decisions, increasing operational efficiency and effectiveness, minimizing financial risk. For stakeholders, deciding on investment or funding, assessing company performance, monitoring investment risk, making decisions regarding relationships with the company. Conclusion. Financial statement analysis is an important process for understanding the financial health of a company. By using the right analysis method, companies and stakeholders can obtain valuable information for better decision-making. Here are some examples of commonly used financial analysis reports. 1. Financial ratio report. Liquidity ratio shows the company's ability to meet its short-term obligations. Examples: current ratio, quick ratio, cash ratio. Solvency ratio shows the company's ability to meet its long-term obligations. Examples: debt-to-equity ratio, long-term liquidity ratio. Profitability ratio shows the company's ability to generate profits. Examples: gross profit margin, net profit margin, return on equity, ROE. Activity ratio shows the company's efficiency in managing its assets. Examples: inventory turnover, accounts receivable turnover, asset turnover. 2. Horizontal analysis report. Sales development report compares sales in the current period with the previous period, showing trends in sales growth or decline. Net profit development report compares net profit in the current period with the previous period, showing trends in profitability. Asset development report compares assets in the current period with the previous period, showing the trend of changes in the company's asset structure. 3. Vertical analysis report. Revenue structure report shows the proportion of each type of revenue to total revenue. Cost structure report shows the proportion of each type of cost to total costs. Asset structure report shows the proportion of each type of asset to total assets. 4. Cash flow report. Cash flow report from operations shows the cash flow generated from the company's operational activities. Cash flow report from investment shows the cash flow generated from the company's investment activities. Cash flow report from financing shows the cash flow generated from the company's financing activities. 5. SWOT analysis report. Strengths, competitive advantages owned by the company. Weaknesses, limitations or deficiencies owned by the company. Opportunities, external factors that can be utilized by the company to achieve its goals. Threats, external factors that can hinder the company in achieving its goals. 6. DuPont analysis report. DuPont analysis report is an analysis method that breaks down ROE, return on equity, into several more specific ratios, helping to understand the factors that affect the company's profitability. 7. Sensitivity analysis report. Sensitivity analysis report predicts the impact of changes in key variables on company performance. Example: sensitivity analysis of changes in selling price, production costs, or interest rates. The examples above are only a small part of the commonly used financial analysis reports. The type of report needed will depend on the purpose of the analysis, the type of business, and the needs of stakeholders.